Cartland. I'm the principal of Cartland Law. Today I'm going to talk about business structures and business structure of a partnership. So a partnership is where two or more people undertake an enterprise together for the purpose of profit or gain. So you might have a formal partnership agreement, or maybe it's something informal. Maybe you're doing it together. It's called a joint venture or a partnership. There is a distinction, but people often don't understand that a joint venture is where you share in the results of something. Say if I say I'm going to divide some land and we'll each keep part of it, or we're going to mine some gold and we'll each share it. Whereas a profit is where a partnership is where you share the income, and you will have it by default equally, but you can easily have a partnership agreement where one person has 70% and the other person has 30%, or you can also create some flexibility in there, change it from year to year, change it from time to time, but by default it will be by equality. So the advantages of a partnership is this is a business structure that governs multiple people. It's very simple. You may use a partnership agreement. Most people do. Technically, you don't need to. There is a partnership act that governs it. Partnerships, and simplicity. You're going to want to register a business name, register for GST if you're going to be earning more than $75,000 a year, or if you want to claim input tax credits, claim your GST back on things that are used in the business. You don't need to register with ASIC or any central place. You can call, subject to business names register, you can call the name of the partnership, generally whatever you want. You're going to access people's marginal tax rates, and so if you're not earning hundreds of thousands of dollars a year each, that's going to be fine. Now, comparing it to the corporate tax rate and what your individual tax rate is, it's a bit of a balancing act, but often the marginal tax rate can be fine. Often if you have a bunch of people who have a services profession together, say some hairdressers working together or some professionals working together, a partnership is an ideal structure for them. It is simple. If you do sell the business or sell off parts of it, bring in another partner who contributes capital, you can get the 50% capital gains tax discount. It's very easy to access the small business capital gains tax concessions, which can reduce your CGT by another 50%, so down to 25% in total, or even reduce it completely. Disadvantages, biggest disadvantages, there's no asset protection. You are individually in this business. If you get sued or you incur a whole bunch of debts from trade creditors or from tax or from something else, you are personally on the line. Your assets are at risk. The family home can be lost. There is no corporate tax rate, and so if you start earning really good money, which say if you're earning more than $80,000 or $180,000 a year, if you're earning more than $180,000 a year each, you're going to be on the highest marginal tax rate, which is 46.5% plus the Medicare levy. Compare that to 27.5% for the corporate tax rate. That's nearly 20 points, or it could be over 20 points when you look at the Medicare levy. And it's a huge difference. So the missing out on the corporate tax rate is a big problem with a partnership. Here, this is a partnership of individuals. There's no income streaming. If you have a spouse outside of the partnership, then you can't distribute out to them. There are ways. There's a thing called an Everett assignment. There are other ways of bringing the person into the partnership. These are a bit more complex. They require a bit of thinking, a bit of legal work, and so in your default partnerships, you're going to miss that. Now, a partnership, in a way, is often used as income streaming. For many years, it was the default way of splitting income between a husband and a wife. They would, say the wife is running a business, and then then adds the husband as the person who's doing the books, doing some accounting and back end work, and then so they're in a partnership together, and then therefore you split their income. It's generally not generally not hugely used like that anymore. It's much easier to use a discretionary trust, put in a discretionary trust, and you can change it from year to year. I mean, you can have a partnership that is discretionary, but again, that's stepping up a level of complexity. It's not the starting point for a partnership. Most people that go into a partnership of individuals, it's going to be fixed. You don't end up with that income streaming. You don't get the research and development tax credit, so this is not really a suitable structure for people who are having a tech startup, because you miss out on that 15% that you can get back from the government, or 45% if you are making losses. So partnership used to be a really great and really common business structure, particularly farms, families, small businesses, and because when you're adding a couple of people in there, then there is some kind of sharing of the income. It's definitely fell on the wayside to discretionary trusts, running the business, or companies owned by discretionary trusts, where you lock in all of these, you manage to get all of these benefits as well. So you grab your limited liability, your corporate tax rate, your asset protection, and research and development tax credit, income streaming. So this is partnership. I would suggest is used for some simple businesses, often professionals, people doing services. There's a couple of people who want to keep their life uncomplicated, and they're very easy to set up. You can easily generate a partnership agreement for online, or go and get some specialist tailoring if you want a more complex agreement between you. Thank you very much. My name is Adrian Cartland, Principal of Cartland Law.